So you're scrolling through your phone at 2 in the morning and you see an ad for that credit card with the amazing cashback rewards. You click apply, feeling pretty good about yourself. 30 seconds later, denied. And here's the worst part. You have no idea why. You pay your bills, you have a job, you're a responsible adult. But somewhere in the background, there's this 3-digit number that just decided you're not worthy of a piece of plastic. And the really frustrating thing? Most people have no clue what that number actually means or how it got there in the first place. My name is Ashraf, and I spend way too much time thinking about credit scores and why they control so much of our financial lives. If you're someone who's ever been confused about why you got denied for credit, or you're paying higher interest rates than your friends, or you just want to understand how this whole system actually works, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because here's the thing, your credit score isn't just some random number. It's literally costing you thousands, sometimes tens of thousands of dollars over your lifetime, and most people are walking around completely blind to how it works. Look, I'm going to be straight with you. According to a 2023 study by the Consumer Financial Protection Bureau, about 45% of Americans have never checked their credit score in the past year. 45%. That means nearly half the country is operating in complete darkness when it comes to one of the most important financial metrics in their lives. And the consequences? They're massive. Here's what most people don't realize. The difference between having a credit score of 650 versus 750 can cost you over $64,000 in additional interest payments over the life of a typical 30-year mortgage. $64,000. That's not a typo. That's the price of financial ignorance right there. And we're just talking about one loan, one decision. So let's break this down from the ground up. Because if you don't understand what a credit score actually is, you can't possibly optimize it. Your credit score is essentially a 3-digit number that ranges from 300 to 850. It's a mathematical representation of how likely you are to pay back borrowed money based on your past behavior. That's it. It's not a judgment of your character. It's not a measure of your income. It's purely predictive. Will you pay back what you borrow? Now, here's where it gets interesting. There isn't just one credit score. There are actually dozens of different scoring models out there. But the one everyone talks about, the one that matters most, is your FICO score. FICO stands for Fair Isaac Corporation, the company that created the most widely used credit scoring model back in 1989. About 90% of lenders use FICO scores when making lending decisions, according to FICO's own data. But here's what throws people off. You also have something called Vantage Score, which was created by the 3 major credit bureaus as a competitor to FICO. And then you've got industry-specific scores for auto loans, mortgage loans, credit cards. It's a whole ecosystem. But for our purposes, when we talk about your credit score, we're primarily talking about your FICO score, because that's what actually matters when you're trying to get approved for major financial products. Now, you might be thinking, okay, who's actually calculating this score? And this is where things get a little weird. Your credit score is calculated based on information collected by 3 major credit bureaus: Equifax, Experian, and TransUnion. These are private companies that collect data about your borrowing and payment history. Every time you open a credit card, take out a loan, make a payment, or miss a payment, that information gets reported to these bureaus. And here's the frustrating part. These 3 bureaus don't always have the same information about you. Maybe one creditor reports to all 3 bureaus, but another only reports to 2. Maybe there's an error on one report, but not the others. This means you actually have 3 different credit scores at any given time, one from each bureau. They're usually pretty close to each other, within maybe 10 to 20 points, but sometimes there are bigger discrepancies. And when a lender pulls your credit, they might look at just one bureau, or they might look at all 3 and use the middle score. It depends on the lender and the type of loan. All right, so how is this magic number actually calculated? FICO breaks it down into 5 main categories, and understanding these is absolutely critical if you want to improve your score. This is where most people get it wrong because they focus on the wrong things. First up, payment history. This accounts for 35% of your score. It's the biggest factor by far. Payment history is exactly what it sounds like. Do you pay your bills on time? Have you ever been 30 days late, 60 days late, 90 days late? Do you have any accounts in collections, any bankruptcies or foreclosures? This category is looking at your track record of actually paying what you owe when you said you would pay it. And here's the thing that surprises people. One late payment can tank your score. If you've got a 780 credit score and you're 30 days late on a credit card payment, you could drop 50 to 80 points just like that. One mistake. Now, the impact lessens over time. Late payments stay on your report for 7 years, but their impact diminishes as they get older and as you build more positive payment history. But that initial hit, it hurts. Second factor, amounts owed, also called credit utilization. This makes up 30% of your score. Credit utilization is the ratio of how much credit you're using compared to how much credit you have available. So if you have a credit card with a $10,000 limit and you're carrying a $5,000 balance, your utilization on that card is 50%. Now here's what most people don't realize. The ideal utilization rate is actually below 10%. Not 50%, not 30%, below 10. According to data from credit experts, people with the highest credit scores typically keep their utilization under 10% across all their cards. But most financial advice out there tells you to keep it under 30%, which is technically fine, but not optimal. If you want an excellent credit score, you need to be using very little of your available credit, even if you pay it off in full every month. And this is where the psychology gets interesting. People think, well, I pay my statement balance in full every month, so my utilization doesn't matter. Wrong. Your credit utilization is typically calculated based on the balance that gets reported to the credit bureaus, which is usually your statement balance, not your current balance. So even if you pay in full, if your statement closes with a high balance, that high utilization gets reported and can hurt your score. Third factor, length of credit history. This accounts for 15% of your score. This is measuring how long you've had credit accounts open. It looks at the age of your oldest account, the age of your newest account, and the average age of all your accounts. The longer your credit history, the better, because it gives lenders more data to assess your behavior patterns. This is why closing old credit cards can sometimes hurt your score, even if you don't use them anymore. When you close an old account, you're potentially reducing the average age of your credit history, especially if it was one of your oldest cards. Now, the account doesn't immediately disappear from your report. Closed accounts in good standing can stay on your report for 10 years, but eventually they fall off, and when they do, your average age drops. Fourth, credit mix, which is 10% of your score. This looks at the variety of credit accounts you have. Do you only have credit cards, or do you also have installment loans like a car loan, student loan, or mortgage? The scoring model likes to see that you can responsibly handle different types of credit. It's not a huge factor, only 10%, but it can make a difference, especially if you're trying to push from good credit to excellent credit. And finally, new credit inquiries, which make up the last 10%. Every time you apply for credit and a lender does a hard pull of your credit report, it creates a hard inquiry. Too many hard inquiries in a short period can hurt your score because it looks like you're desperately seeking credit, which might indicate financial distress. Each hard inquiry typically knocks off about 5 points, and they stay on your report for 2 years, though their impact fades after about 6 months. Now you might be thinking, wait, if checking my credit hurts my score, how am I supposed to monitor it? Good question. There's a difference between a hard inquiry and a soft inquiry. When you check your own credit score, that's a soft inquiry. It doesn't affect your score at all. When a lender pulls your credit because you applied for a loan or credit card, that's typically a hard inquiry, and it can affect your score. So you can check your own credit as much as you want without any penalty. All right, so we know what a credit score is and how it's calculated. But why does this actually matter? Why should you care about this number? Let me show you the real-world financial impact, because this is where things get really interesting. Let's say you want to buy a house. You're looking at a $300,000 mortgage with a 30-year fixed rate. If you have excellent credit, let's say a 760 score, you might qualify for an interest rate of 6.5% as of late 2024. Your monthly payment would be about $1,896, and over 30 years, you'd pay approximately $382,500 total, with about $182 of that being interest. Now, let's say you have fair credit, around a 620 score. Same house, same loan amount, but now you're looking at an interest rate of around 8%. Your monthly payment jumps to $2,201. That's an extra $305 every single month. Over 30 years, you'll pay approximately $792,400 total, with about $492 being interest. That's an extra $110,000 in interest payments just because of your credit score. $110,000. That's a college education. That's a comfortable retirement fund. That's financial freedom you're giving away because you didn't understand how credit scores work. And it's not just mortgages. Auto loans, personal loans, credit cards, they all use your credit score to determine your interest rate. According to data from Experian, the average interest rate on a new car loan for someone with super prime credit, that's a score above 720, was around 5.6% in 2023. For someone with subprime credit, below 620, the average rate was over 11%. On a $30,000 car loan over 5 years, that's the difference between paying about $3,600